Good morning to all of you here at our school, CamEd Business School. And as always, it is a great pleasure for us to always welcome great people, great experts that know the industry very well to be here with us today. For the second time, Professor Charles Whitehead, he's from Cornell Law School. So what a pleasure to welcome you back, Charles.
Thank you.
So I hope your stay here with us has been good.
Great. Thank you very much.
Great. Okay, so let's get it going. Now, I know that your background is pretty much in security law, equity, bonds, and also broadly in corporate law in general, right? So why don't we start off by, these days people are talking so much about uncertainties caused by the recent tariff, a lot of talk in Washington, Trump administration, all of that. So that put people into like uncertain mode, right? What's going to happen tomorrow? Because every day you would hear from him 3 times on his True Social, what that's wrong. So has that created somehow uneasiness for investors? What the U.S. capital market
Sure.
has to face? So take us through.
Okay, so let's divide the world between the equity markets and the bond markets.
Yeah.
And talk a little bit about each and how some of the uncertainty in the market has affected them.
Sure, please.
So markets by their nature are predictive. And what that means is they're looking into the future. They are trying to get a sense of what the world will look like 1 month, 1 year, 5 years, 10 years from now. And that gets reflected in both the equity markets and the bond markets. They are looking at different factors. We'll go into those in a moment. But the idea is they are predictive. And so when you see things like changes in U.S. administration or changes in tariffs or things that might apply to the economy generally, it might be a war,
Right.
could be a pandemic. These are all things that, if you look into the future, will have some sort of an impact. Now, what makes the markets somewhat uncertain is it's not clear what the impact will be. You might think it's a different impact than what I think.
Right.
Maybe you've done more research and you've decided it will have this effect or that effect than the research that I have. And so even though the markets are predictive, because you are trying to make an estimate of the future, it means they're also not going to be exact.
Right.
So when we're talking about the stock markets, you're really focused on the impact of whatever it is you're looking at on the profitability of the company, the net income, the money that the company is going to earn. And so you're looking out 1 year, 5 years, whatever, and you're deciding what the likely impact on profitability will be.
Right.
So for example, if you see an increase in tariffs, it means that for some companies, this is going to be quite disruptive. In fact, for most companies, it's going to be disruptive. At least that's how the market perceives this. And that's because the price of everything will go up. It'll be more difficult for people to buy different products. As a result, you're going to see a drop in sales. And the impact is going to be, some impact will affect the profitability of the businesses. And so as a result of this increase in tariffs, you saw a drop in the stock market. And that was anticipating the likely impact on the company's profits 1 year, 2 years, whatever the time period was, based upon the market's assessment of what it meant to have these types of tariffs.
Right.
The bond market is also predictive. It's also looking at the quality of the issuers, good credit, bad credit, strong, not so strong. And so again, the profitability is relevant, but they're also looking at interest rates. Now, to understand this, you have to understand what a bond is. And I know you do, but we'll do this for the students. So bonds are basically a loan with a return on that loan. So if I buy a bond for $100, it means I'm going to, at some future point, get my $100 back, plus some interest on this. Let's make it simple. Let's assume that it's a fixed rate of interest.
Okay.
So I have a bond. It's going to return 3%, let's say, over the next 2 years. In 2 years' time, I'll get my $100 back. But between now and then, I'll have 3% per year of a return. Now, if interest rates go up, in other words, if the cost of borrowing goes up, It means that the value of my bond will go down. So let's say, for example, that the amount that you have to pay to borrow money goes from 3% to, let's say, 5%.
Uh-huh.
Well, everybody else that buys a bond going forward will have $100 plus 5%. I'll have bought the bond for $100. It yields 3%. So what do you think happens to the value of my bond? It drops because it gets a lower return.
Yeah.
And so when you're investing in bonds, you're also making a prediction about future interest rates. Now, what happened with tariffs? Because of the tariffs, the view was that the cost of everything would go up, that there would be inflation. Means that the cost of buying, a can of Coke, cost of buying a cell phone, the cost of buying a car, all of these things would go up because the components would all now be more expensive, and so I'd have to go ahead and pay for more. Well, inflation hurts lots of people. It means that your paycheck does not go nearly as far. Uh, Sometimes it's an indication that the market is a little bit too hot in the sense that relative to demand, there isn't enough of the product out there. And so the central bank will very often, in that case, increase interest rates. And the reason they're increasing interest rates is they're basically trying to slow things down. They're saying to the company, look, we're going to make it more expensive for you to borrow money. And so that means that you are less likely to continue to buy things. It'll lower the demand. And so it will have an impact on inflation. It will lower inflation. And so it's not uncommon when you see this inflation, this increase in price, for example, as a result of tariffs, it's not uncommon for people to anticipate that the central bank, in the United States, it's called the Federal Reserve, that the Fed is going to increase interest rates. So, what happened when tariffs went up? You actually saw, quite unusually, a drop in both the stock market and the bond market. Usually they go against each other. But in this case, they both dropped. And the reason that the stock market dropped was tariffs were viewed as having an impact on profitability. And so stocks aren't going to be as valuable. But because of the inflation caused by these tariffs, everything now costs more. The expectation was that the Federal Reserve would increase interest rates. And so the bond that I have, which yields 3%, would now be worth less because going forward, interest rates would go up. And so future bonds would be issued at 5% or whatever the rates was. So you actually saw a drop in both markets, which is quite unusual. But it gives you a sense of just how impactful this tariff was, or the threat of the tariffs was. Now, as an aside, as many of your students probably are aware, these tariffs were announced and then they were suspended, and then they were announced and then they were suspended. Right. So what do you think happened to the stock market? Well, they get announced, the market drops. They get suspended, market goes up again. They get announced, the market drops. And so traders, they are not so slow. They figured this out. And so there was a trading strategy that was developed,
Right.
where traders would go in, buy as soon as the tariff was announced, with the expectation that it would be pushed off. Stock price would go up, they'd sell again. Second tariff gets announced, they buy again, and so forth. And so, in fact, because of this odd thing that's happening with tariffs, you're also seeing changes in trading strategy, taking advantage of this potential impact.
Okay. So obviously this thing has happened before, right? So I think like back in the day, the financial crisis 2007 to 2008, and then later a couple of years ago, the Silicon Valley Bank went bust and all of that. So a lot of uncertainties have happened. And of course, that caused fluctuation in your stock market and all that. So built on those past experiences, is today that thing that's happening today are any different, or should you expect the same?
So today is quite different. Yeah, it's quite different for a number of reasons. So first of all, it's different in the sense that it is much broader, much more universal than anything that you've seen in the past, at least as far as tariffs go. Secondly, it's being imposed externally. It's the government stepping in and saying, "Here's what we're going to do." When you had the financial crisis, of course, it's the financial market. It's all man-made, but it wasn't any one government entity stepping in and saying, "We're just imposing this." So it was much more fundamental in the case of the financial crisis. Silicon Valley Bank we'll put aside for a moment. Silicon Valley Bank had its own odd things. But what makes the tariff structure unusual is it's imposed sort of externally by the government. And because of this, it gets pushed in and then pulled back and pushed in and pulled back. And it's that level of uncertainty that is covering the entire market that's created this heavy disruption. When you had the financial crisis, of course, there was disruption, but it wasn't in and out, in and out. It was just in.
Right.
And it took many years for it to be unraveled and fixed. But it was a cooperative effort by both government as well as the industry to sort of address the problems, as opposed to having these sort of external costs being put in and then taken out. That's what makes this so unusual.
Right. Now, going back to our recent discussion when at what point we were talking about the increased number of bankruptcies being filed in the US, and I think the latest figure puts it at around 7,000 bankruptcy cases being filed last year alone, 2024. So, okay, so that tells us going bankrupt is not unusual. All right. So, you run a business, it doesn't make it, well, you file for bankruptcy. Now, connect that to the bank, the Silicon Valley Bank. How did it go bust?
Sure. So let's take a step back again for your students on what happened with Silicon Valley Bank. So Silicon Valley Bank, as you can tell by the name, is focused on tech startups. Um, their particular specialty was biotech, but they were doing tech startups generally. There's Silicon Valley Bank. What made them unusual is their heavy concentration into startups.
Aha. So they would always give loan to startups people.
They would give loans to startups. They would take deposits from startups. And very often the people that they took deposits from, they would make loans to, but they were very, very well known within the startup community.
Okay.
And what that meant was they were also concentrated into startups. One of the things that banks do, one of the things that banks are supposed to do is manage money coming in versus money going out. Bank academics, people who write about this, they talk about it as temporal transformation. They're changing the time length of money.
Right.
So let's say one of your students has $100 and they put it into the bank. They expect to be able to get that $100 back out at any time.
Sure.
What has the bank done in the meantime? They've taken this $100 and they've invested it.
Sure.
They've invested it by learning it out. When they make the loan is being made to someone who's borrowing, who expects to be able to hold this money for 1 or 2 or 3 or 5 years or whatever. So already there's a match. The bank is in the middle. You've got the depositor that puts the money in, expects to get it out at any time. You've got the bank that has taken the money, loaned it out for an extended period. And the bank is in the middle and they're balancing the two. If you want your money back after you've put in the money for deposit, the bank has got to figure out how to get that money to you because they've gone ahead and invested it. What Silicon Valley Bank did, and it ties into what we were talking about a few moments ago, Silicon Valley took the money that was coming in from their depositors, most of whom themselves were startups, and they did two things. One, they were lending it out to startups, and two, they were also investing into long-term treasury bonds.
Ah.
Now remember, long-term bonds go up and down in value based upon expected changes in interest rates, right? It turned out that Silicon Valley Bank bought a lot of long-term bonds. They thought that they would get a really good return on these bonds, and they also loaned out a lot of this money to other startups, figuring they would get a really good return. Interest rates went up. And they went up at a time when Silicon Valley was beginning to experience some disruption. People were not investing as much into startups. So you had startups who were very much dependent upon venture capital and other investors suddenly needing to go to the bank to get their money because they had to pay people and so forth. At the same time, you had interest rates going up, so the value of the bonds that Silicon Valley held began to drop. And you also had greater uncertainty in Silicon Valley among startups, so the value of the loans began to drop. So Silicon Valley Bank was in this tough situation
Right.
where they had to give money back to their depositors, but the value of the assets they had invested in was now
That's
less.
right. So liability stays, but the value went down. So now you had a complete mismatch. You couldn't pay.
How do they pay people back?
That's right.
And so as a result, there was a panic among the startups who said, hold on, we can't get our money back. This is a problem. And because these were all tech companies, social media pushed it out very fast. Everyone talked about this on social media, and there was what's called a bank run.
So everyone went to the bank, ATM machine, tried to get money.
Send me my money back. Now, this is a common problem for any bank, right? Banks are always worried about this. One of the ways in which you stop this type of bank run from happening in the United States, there is a group called the FDIC, Federal Deposit Insurance Corporation. They are a government-backed group, and they will insure up to $250,000 per deposit, per account. So if I have an account, a deposit at Silicon Valley Bank, $250,000, if Silicon Valley Bank can't pay me back, I don't care. The government will give me back the money. And the FDIC is very efficient. They'll make sure I get the money back. It's something that you can feel very comfortable about. For some odd reason, the startups put in a lot more than $250,000
Of course.
into Silicon Valley Bank. There were even cases of companies putting in hundreds of millions of dollars into Silicon Valley Bank with only $250,000 guarantee. So they really panicked, right? So you had a bank run because the normal ways in which you protect against this type of bank run didn't really check them anymore. And you suddenly had everybody concentrated among startups, both not being able to repay the money as quickly to the extent they were borrowers. There was a real question as to the stability of these borrowers, and at the same time looking to get their money out of the bank as depositors. So Silicon Valley Bank suddenly couldn't pay people, and that's what caused this collapse. The government had to step in. The government decided to help basically pay people. They provided a guarantee beyond the $250,000 simply because of the very special problems that Silicon Valley Bank had. You can really view this as a mistake within Silicon Valley.
Right.
They had not properly managed the risks the way a bank should. And that was because they were overly concentrated into tech startups.
So I hope the CEO didn't get bonus.
I suspect the CEO did not get a bonus. The risk manager, there were real problems with the risk management system. That's right.
Okay. Well, exciting because you know what? In our country, Cambodia, at the moment, I think the discussions are that people are trying to establish something like DFIC, which we still don't have, right? So I'm hoping that in the future we will have to create this as soon as possible, just in case it happens. Now, let me shift the attention a little bit. This morning, in your lecture, you talked about liability, right? Limited liability companies, and in which the role of the board of directors become crucial. Sometimes we hear about duty of care, duty of loyalty. Maybe one word on that, please?
Sure. So the way to think about it in the corporate form is shareholders give a lot of power to the managers of the business. And one of the reasons they're comfortable to give this authority to the managers is because the shareholders have limited liability. Limited liability means that if there are obligations or liabilities incurred by the company, the creditor, whoever it is that is owed money, can simply go against the assets of the company, and that's it. I cannot go through the entity and get the assets of the shareholders. Right. And so because of this, shareholders, it's not that they have no liability, they have limited liability. The liability is limited to the amount of capital in the company that they have invested in. Because it's limited liability, the shareholders give more discretion to the board. Board of directors, you can decide how to run the business. Managers, you can decide how to run the business. We, the shareholders, sure, we have some power. We can vote for you to be in, vote for you to be out, but otherwise we'll let you run the business. Here's the problem. The problem is managers very likely have a different sense of how they want to run the business than shareholders. Shareholders want to make a lot of money. They want to make a lot of profit. They want the stock price to go up. The managers of the company are not necessarily thinking the same way. Maybe they are worried about losing their job, so they'll be a little bit more conservative. Maybe they want a private jet. They think they should get a private jet because that's what they should get. Not sure that the shareholders necessarily think this is the right thing. So there's a difference in the way in which they view the company based upon kind of their relationship to the company. To the extent that the managers may run the business in a way that hurts the shareholders, then if you're a shareholder, you're going to be a little bit more nervous. If I put my money in this company and the managers are going to run it in a way that hurts me, that means my risk is too high. And if my risk is too high, maybe I expect a greater profit. Maybe I won't invest as much because I'm just worried about putting my money into this company. This is where fiduciary duties come in. Fiduciary duties are intended to align the interests of the managers and the shareholders. Strictly speaking, the fiduciary duties are not directly to the shareholders, they are to the company. The company is a legal entity, it's a legal person, and so the duties run to the entity, but they are for the benefit of the shareholders. And the three fiduciary duties that you see commonly are the duty of care, the duty of loyalty, and the duty of good faith. So the duty of care is basically saying, look, be careful in how you run the business. Run the business the way you would run it if it was your own money. Ask the right questions. Get the right information. Be thoughtful and deliberate in the decisions that you make in running the business. And again, the idea here is, as a shareholder, you want to know that even though the board has this broad discretion in running the business, that they will run it in a way consistent with what a reasonable person would do in running their own and managing their own.
What a diligent person would do.
Reasonably diligent person would do. The duty of loyalty goes much more to whether or not I put the interests of the company ahead of my own. And so in the duty of loyalty, you expect the directors, the officers, to place their interests second.
Right.
To the extent that they are given an asset, for example, a laptop, or to the extent that they are asked to run the business, or to the extent they become aware of a corporate opportunity we discuss, they will put their interests second and they will put the interests of the company first.
Right.
And so the duty of loyalty is critical. If there's a conflict of interest, it's a problem because it raises a question about whether, in fact, you are able to put the interests of the shareholders ahead of your own. And so we focus very much on the duty of loyalty in the sense that we want directors, because they have their own interests, to put the interests of the company ahead of theirs.
So in the US as here, when people talk about derivative action, when a board somehow made poor decisions that no one should have made, then shareholders in the US, for example, are in right to bring a lawsuit to recover some of the damages caused by poor decisions of the board, correct?
Yes and no. So, so a derivative action is an action by the shareholders standing in the shoes of the company.
Right.
They're actually representing the company. And so if they win, whatever damages that are paid get paid to the company, not to the shareholders.
Right.
We'll come back to why they do this in a moment, this lawsuit. So they bring this claim on behalf of the company for a breach of a duty. Typically, what the courts focus on is the process by which the decision was reached. It's not whether it's a good or a bad decision or whether you or I would do it. It's whether or not there is a reasonable basis for the decision,
Right.
that is free of any sort of conflict on the part of the board members. So it's not whether or not you think the decision or the shareholders think the decision is reasonable. The question is whether there is a rationale for it. Is it a rational decision? Is there a basis for it, as opposed to whether or not it's reasonable?
Right.
You and I might think that what the board has done is completely unreasonable. But so long as the board has a basis, a reasonable basis for why they did what they did, the courts will tend to defer to the board of directors.
Right.
They don't want to second guess the board. And that's because the board was elected by the shareholders. So one question to ask is, well, hold on, if these derivative suits are being brought by shareholders, but they're not getting the money directly, the money is going back to the company, why are they doing these lawsuits? I mean, after all, if I only own 100 shares and there are 10 million shares outstanding,
Why should I care?
why should I care, right? So why do these derivative suits come up? Answer is lawyers. Lawyers make a lot of money on these suits. And so when they win, they get paid a fee.
That's right.
So the individual shareholders, the person that owns only 100 shares, may not benefit. The company benefits, and indirectly the shareholders benefit. But in many cases, the real driver, it's the lawyer.
Interesting to know that. Okay. Now, you also mentioned the loyalty, right? Because I usually put it as simply as this. When we look at duty of care, you look at two basic things: the head and the heart. The head refers to the duty of care: be knowledgeable, ask questions, know what you're talking about, be experienced. But the loyalty goes deeper because it checks whether you have honesty or not. So usually when I tell students you have to have both head and heart, they know what I'm talking about. Is that a fair assessment?
Yes. Being a law professor, I'm going to be a little bit. I'll change the vocabulary a bit. So in the case of liability under the duty of care, the question is whether or not you have been grossly negligent, right? Not just that you've made a mistake, but it's something in excess of a normal mistake. And so in that respect, it's your head, right? Am I reasonable? To the extent that it's not reasonable, is it something that is more than just simply negligence and a mistake? Is it grossly negligent, right? When you're talking about the duty of loyalty, it's something in excess of gross negligence. It's like recklessness, right? So clearly, if I am doing something subjectively to hurt the company, clearly that's well in excess of gross negligence. That's my heart, right? And so that would be a breach of the duty of loyalty. But you would even find a breach of the duty of loyalty if it was something in excess of gross negligence. So if it was something where I was a reckless disregard, I knew about it, but I didn't pay attention to it, right? So I don't even have to be deliberate. Just simply, I'm not paying attention, knowing that there is a duty, I still don't pay attention. That would fall within this recklessness concept, which is in excess of gross negligence, and that would fall within the duty of loyalty.
So usually, the way it happened is that, you said mostly because lawyers want something, but usually it gets filed by minority shareholders more often than it gets filed by majority shareholders, right? Yeah, okay. And maybe that because usually minority shareholders not having their people represented on the board, they sometimes they don't know what's going on, right? So
if you're a majority shareholder, you don't need to sue because you control.
that's right.
I can always vote out the directors if I don't like what they're doing. The minority shareholder sues very often when there is some special benefit that the majority is getting,
Right.
that the minority doesn't get. So to the extent that there is a transaction between the company and the majority shareholder, majority is on both sides, right? They're on the one side of the deal as the shareholder, but because they control the board, they're on the other side.
Yeah.
That will raise all sorts of concerns about conflicts of interest, duty of loyalty.
Yeah.
And the minority shareholders will perhaps sue if they think that it was not done in a fair way. But if whatever the transaction is benefits everyone equally, it's hard to argue that there's a basis for the duty of loyalty. So, for example, let's say the majority shareholder says, hey, I think I'd like a dividend. And they tell the board of directors, hey, you should really think about a dividend. And the board of directors issues a dividend to everybody,
Right.
including the minority shareholders. It's hard to argue there's a breach of a fiduciary duty. I mean, if they are just simply following the direction of the majority shareholder, maybe they have a problem under the duty of care because they're not making a judgment.
Right.
They're just simply following. But assuming they make their own determination, even though it's being pushed by the majority shareholder, right? The fact that they have made their own determination makes it hard to argue that this is any sort of a breach.
Now, as you were explaining earlier about equity and bond markets, I couldn't help thinking about this because, you see, in Cambodia, our capital market is small. It's growing, but the volume is still small somewhere, So, meaning we really trying to kick this, right? We want to expand the capital market so much. But what we have noticed in your country, it's almost the reverse. In the past, there used to be a lot of people listed on the stock exchange, but now it's less and less. So now more and more companies that used to be listed became delisted, and now they actually become privately owned companies. So why is that reverse?
Sure. So it's really a cost benefit analysis, is the way to think about it. There's a real benefit to being public, to being on the New York Stock Exchange. The benefits are my stock is liquid. It now trades.
Right.
And, if you are a shareholder, that's good because you can sell the stock. You can buy more stock. If you're the CEO, that's good. If you get paid in stock, now it's more liquid. There's a reputational benefit. Hey, I'm on the New York Stock Exchange. I'm a global company. Maybe people take you more seriously. Very often, if you are on the New York Stock Exchange, the cost to you of borrowing money goes down.
Right.
Banks are more comfortable lending to me.
They respect you more.
They respect you more, and I can raise money through the equity markets, and so it's a convenient thing for and as far as the debt markets go. Public stock is also an acquisition currency. Now, if I wish to buy another company, I can pay cash. I can sometimes borrow the money and pay cash, but now I can also give stock. And so it creates an acquisition currency. So there are a lot of benefits of being public, but there are also costs. The costs of being public have gone up significantly in the last 20 years in the United States. There are a whole series of laws that were passed really in response to problems in the marketplace. Right. There were some well-known scandals among large companies in the early 2000s. We had the financial crisis in 2008. And so as a result, the types of things you have to do as a public company became more and more difficult to comply with. The laws required additional reporting. Right. They imposed additional liability. More disclosure. They forced the board of directors to operate in a certain way. And so for many companies, they said, well,
It's not worth it.
it's not worth it. So let's go ahead and just get off the market. Now, you might say this is a problem because it means that there are fewer companies that are public. On the other hand, maybe these are the companies that shouldn't have been public anyways. So it's not like it's necessarily a bad thing to the extent that they are the companies that are the weaker companies. The other thing that happened during this same period is the private capital markets in the United States became bigger.
That started back late 80s, something?
Late 80s, early 90s.
Okay.
So today, 80% of the equity markets in the United States are institutional. What that means is, it's banks, it's insurance companies, it's funds. 80% of the market.
Sure.
These are very large, sophisticated institutions who really don't need to have to buy and sell stock on the New York Stock Exchange. And so the laws shifted beginning in the early 90s. They continued to become more and more flexible so that today you can be relatively liquid. I can buy and sell stock and yet not be on an exchange.
That's right.
And you can do this because so much of the market is now institutional. I don't need to worry about selling to mom and dad. Mom and dad are not that sophisticated. They're not that big. much easier for me to sell to another big institution, much less expensive. And so you saw the benefit of being public go down, the cost of being public go up, and the benefits of being private go up. And so as a result, not surprisingly, you saw a shift from the public markets into the private markets.
Right. Okay. Wonderful. Now I know that if I could keep you forever, but I can't. So let's go down to the very one last final question. This is entirely American law, but I think it's for the benefit of everyone listening. You have many states, right? 50 states. The most famous one, Delaware. And recently, as you have told me, that there has been a movement to change the law, so much so that if you are incorporated in Delaware, wherever you go, wherever your assets might be located elsewhere, whenever there's a lawsuit, it will be Delaware law regardless of where you physically found yourself to be. And so that has created some tension, some uncertainty, or not, because to lawyers, they feel like, hold on a second, every state has its own corporate law, so to speak. Why is it that Delaware is so special that Delaware law goes with you wherever you go? What the heck?
So when we talk about Delaware law going with you, what we really mean is as it relates to internal governance matters. So it's the relationship between shareholders and directors and officers. It's referred to as the internal affairs doctrine.
Internal affairs, yeah.
And the idea is to actually try to decrease uncertainty. So let's say, for example, you're a Delaware company. Or it doesn't have to be Delaware. It could be a New York or a California or Illinois company. And you're incorporated in that state, but you happen to have your headquarters in New York. Yeah. Maybe you have factories in New Mexico. You have board meetings in California. You have shareholders in South Dakota. What law should apply?
That's right.
And the idea behind internal affairs was to try to make it less unclear that when it related to internal relationships, regardless of where the lawsuit was brought, it would always be Delaware law. So that way you didn't need to worry about, where my shareholders are, where my factories are, where my officers are, that in all cases it was going to be Delaware. Now, it does raise some issues.
Yeah.
Let's say, for example, it's a Delaware corporation, but your directors, your officers, your headquarters, your factory, your customers, maybe even your shareholders are all in New York. Why should Delaware law apply in that case? Doesn't New York have a compelling interest in applying New York law? And the answer is sure, but it's balanced against the uncertainty that would result if you permitted New York to step in. Because today, the directors and the officers and the factory and the headquarters are in New York, but 6 months from now, maybe they're in New Jersey, or maybe they're in Florida. Well, does that mean that the law now changes? At what point does it change? If you are a shareholder, this means you're not quite sure what your rights are if you're a director or if you're an officer. And at what point does it shift from New York to Florida also becomes uncertain. Right? So the idea was to avoid that level of uncertainty so that no matter where the company is, you as a shareholder don't have to worry about some change in your rights as a shareholder. As a director, as an officer, you don't need to worry about a change in your liability. Now, there are some states that do have statutes that say we disregard, and we have statutes, California is very famous, that say notwithstanding internal affairs, in the following case, and they usually focus on where are the shareholders, where are the officers, where's the revenue generated. If you meet certain minimums, California law applies in that case. And so you will have cases where Delaware and California do this.
Clash head on.
Yeah. So far, whenever this happens, California has backed off and Delaware has won. So at least so far, even though California has the statute, California has never interpreted it to override Delaware law applying. In fact, it's very common now. So one of the problems with this internal affairs is that if the lawsuit is brought in Florida, do you think Florida courts know the Delaware law so well? Well, maybe. But there's a risk that Florida courts will misinterpret Delaware law. So today, and this has only happened in the last couple of years, most companies in their bylaws, in their constituent documents, have a provision that says if you sue for internal affairs, it can only be brought in Delaware. It can be a state court or a federal court, but only in Delaware.
To make things simpler.
To make it simple and consistent. So that Delaware law will always apply. You don't need to worry about Florida or Wisconsin or California misinterpreting the law. California accepts this provision. So they have not contested it. Right. So it's still possible that in the future, California will say, no, 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 no. Under these circumstances, our law should apply. But it seems as if, at least so far, states are comfortable deferring to the state of incorporation, whether it's Delaware or New York or whatever, again, because of this benefit of consistency in having just simply one state's law apply.
Excellent. Wow, this is very entertaining, legally entertaining.
Yep.
So I thank you very, very much. And I hope that our listeners have got to the bottom of everything, trying to understand, because everything that Professor has shared speaks volume to our realities, because you want it or not, our company law, what we call it law on commercial enterprises, is modeled exactly on common law-based country, including the U.S. law. So therefore, the theories from U.S. law could as well apply to us in the future when we do actually have certain case like this. But until then, thank you very much, Professor Charles Whitehead. It has been a tremendous pleasure for me hosting you, not once, but for the second time. And I hope to bring you back again next year, whenever you want to come.
Thank you all as well. I love you could tell.
See, I had Cambodian and a wonderful suit made of Cambodian silk. So thank you very much. So until next time, bye-bye now.
Very much.